All right, I think we're ready to get started. I would like to thank everybody for standing by and welcome to the AFS Best Practices Weekly Webinar. Our topic today is COVID-19 Impact on Commercial Lending. Our webinar will be approximately an hour long, and I would like to introduce our first speaker today, Dean Snyder, Managing Director at AFS Vision. To enable open dialogue, we will be unmuting all lines. However, we ask that you self-mute, whether it is on your computer or on your phone. To help us manage those that would like to ask a question or make a comment, please use the raise your hand feature. Additionally, you can also use the Q&A feature to ask questions. Direct your questions to the presenter, and we'll leave some time at the end of the presentation so that we may answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email to be able to listen or download the presentation. Thank you for joining us today. Dean?
Thanks, Renee, and thanks, everybody. Welcome to today's webinar as we continue to work through the COVID-19 situation here. Again, from an AFS standpoint, the people at AFS certainly want to recognize everyone out there in the country that's working hard to help us get through this. Certainly our healthcare professionals, first responders, but even down to people who are stocking shelves in the grocery store. And we certainly, I think all of us should be proud of the country we live in and what we're doing to get through this. On today's agenda, we will be featuring Doug Skinner and Lee Kidder, or Lee first, to give us some updates on what's happening with the PPP program and also the EIDL programs from the SBA, a little bit from the Main Street program as that continues to unfold. Doug's going to give us an update on some of the Fed actions, and we'll also give updates around how banks are dealing with loan booking and deferrals and so forth, and also highlight some upcoming webinars that AFS will be hosting around market activity and market topics. Again, we will entertain questions as we go. So as Renee said, if you'd like to use the raise hand feature, we will try to deal with the questions as they are appropriate. And so, Lee, I'm going to turn it over to you.
Okay, Dean, thanks very much. Let me just bring up the slides that I wanted to show here. Put them into presentation mode. Here we go. Thank you, Dean, again, and thanks everyone for listening in for this update. Now that the initial funding for the PPP program has run out, I want to spend just a few minutes giving you a quick review of the activity and information about upcoming new funding for the program. So I'll do a quick review of some of the issues and highlights of the activity in the past few weeks since PPP started. I will show you some statistics that the SBA published at the end of last week about the approved loans that has a lot of information about different states, NAICS codes, etc. And then I'll provide some information on the new funding bill that is just passed to the Senate yesterday and will be working its way through the House of Representatives tomorrow. I'll just add that the slides that I'm about to show you are up to date as of this morning. I have been able to find a few additional bits of information that I will add as it's appropriate to put them in. So the PPP and EIDL programs got off to something of a rocky start. One participant said that it took several days to establish a, quote, working rhythm, which is probably quite true. Another participant described the last few weeks of activity as a stampede through the eye of a needle. There were quite a lot of infrequent changes that were made to the rules and information requirements around the program, which understandably caused a lot of confusion and some delays. A lot of organizations and banks especially raised questions about various legal issues in the program itself. What their responsibility was for eligibility requirements. There was some confusion about affiliation requirements for businesses that were applying for the loans. Questions about underwriting standards and waiting for clarification around the documentation forms that were going to be necessary for approval. I'm sure you're all familiar with a lot of the technical and processing problems that occurred over that period of time. A number of system outages, problems about accessibility, who was able to get authority to enter information, connectivity between some bank systems and the SBA E-Tran system, data requirements that did change from time to time, and of course scalability given the huge volume of loans that were trying to be introduced. There were some delays in what I'll call mid-course corrections through that as well. Sole proprietors and self-employed individuals, for example, had to wait several days before they were going to be eligible or able to submit applications for the loans. A number of fintech lenders and supporters were approved for the program, but really not until the 12th of April, by which time a lot of the funds from PPP were already exhausted. The PPPLF, the PPP loan facility, lending facility, became operational only on the 16th of April, by which time the funds were out. Doug Skinner is going to talk a little bit more following me about this lending facility, but that should make operations for the next round of funding a little bit smoother and more efficient, as well as more funding is available for loans. Now, one point I want to mention is that I'm sure all of us have either seen or read the coverage on television, the press, social media about a lot of these issues and problems that took place with the program. In my opinion, anyway, I think a lot of those stories tended to focus primarily on the negative and anecdotal aspects of some of these problems. We all know that the plural of anecdote is not statistics, but they did tend to focus on the slow disbursements that were going to be going out to the different businesses. The fact that there were some large publicly traded firms that were getting loans. There were some lawsuits filed against a few banks that alleged favoritism and priority. And the end result of a lot of these stories was that the smallest businesses, the little mom and shop operations and sole proprietorships, were being left out of the program. But I think that the real story that should have been emphasized more than it was this last bullet that I've got on this slide. Certainly problems did exist during those few weeks, but the real issue as far as AFS is concerned is the enormity of the strain that this whole process put on the SBA and especially on banks. In 10 days, the SBA and banks set up and pumped through 14 times the usual yearly volume of SBA loans. And that figure doesn't even include the applications that were set up and input by banks, but are still pending approval by the SBA. Now, this is an incredible testament to the dedication and perseverance of bank personnel, especially now in the middle of a pandemic. And that fact is what's important to AFS, and it's why we're making these outreach efforts to provide information, guidance, and service in whatever ways we can. So where are we now on April 22nd with these programs? I'm sure no one is unaware of the fact that funding was depleted last week after only 13 days, 14 days since the program started. But there are a number of statistics that I want to provide for you here and on the following slides. The SBA submitted or published a report last Thursday at approximately noon, so basically when the program was out of money, that provided a lot of statistics about these loan programs. They had approved over 1.6 million loans in the PPP program from nearly 5,000 lenders, totaling $342 billion. Remember that the total outlay for the program was $349 billion, so I'm sure in the remainder of that afternoon it filled out that little bit of leftover. The average loan amount for the PPPs was $206,022. I want to remind you as well at this point that approval of these loans is not necessarily the same as disbursement. That gets back to the issue that was figured a lot in the press about the slowness of some loans getting into the accounts of the actual borrowing businesses. By the same token, the EID program, which I'm going to explain a bit more in just a minute, the EIDL, the Economic Injury Disaster Loan Program, had approved 26,900 loans, totaling about $5.5 billion. And look at the average for these loans. It's within $800 of the same amount of the average for the PPP loans. That EIDL program had a feature that was added in the CARES Act that would have provided advance grants of up to $10,000 for businesses that were in dire need. Those grants had been approved as of the 16th for $3.3 billion. The average was about $4,300. I just want to remind you as well that initially that advance grant was going to be $10,000 for all businesses that applied, but the rule was modified to scale it down to $1,000 per employee of businesses that were applying, up to a maximum of $10,000. That's why the average was lower than you might have thought for $10,000. Now, a fascinating little item here is that that program, the EIDL, which had been funded for only $17 billion for both the loan and grant portions of the program, received applications totaling $383 billion. And a final note, just to put this whole bit of figures into perspective, 1.6 million, the number of loans and businesses that were approved for PPP loans, does represent only a very small amount of the total U.S. small businesses, only 6% of the 25 to 30 million businesses in the U.S. I mentioned the Eid L program. That program, in comparison to the PPP program, of course, was receiving very little attention. And I think as a result of that, in general, not very much is known about what this program entails, what its features are, et cetera. So I've added this table that I found online that shows the key features of the program and how that program differs from the PPP loans. You can read this at your leisure when you download the slides tomorrow. But the key difference is that the EIDL loans, while they're applicable to broadly the same sets of activities that PPP loans are, it is a bit broader. EIDL proceeds can be used for more general business expenses, such as accounts payable, any fixed debts, et cetera, that are prohibited or at least not forgivable in the PPP program. Any one loan could be a little bit larger than a PPP loan. The key feature, though, I think, is that EIDL loans are not forgivable the way PPP loans are. The only difference being that cash advance grant that was added to the EIDL loan by the CARES Act. The EIDL program itself was enacted a few weeks before the CARES Act. But the CARES Act did add that some broadening of the eligibility and features of the program, and it did include that new advance grant. Now, these next several slides I want to show you are what was published by the SBA last week with statistics about the various programs. And I'm not going to go through them except to notice what kind of data is included in each of these slides. You can review them at more time when you download them tomorrow. But this first one indicates state by state how many loans had been approved by the SBA, and of course the total amount for those approvals. And remember again that approval simply indicates that it has been guaranteed by the SBA. It does not necessarily mean that all those businesses have received funds in their accounts. This loan shows the loan size, the number of loans that were approved, and the dollar amounts for various loan sizes. This one shows the industries by NAICS code that had received the loans. The leading industries were construction, professional services, and manufacturing, and healthcare. With the number of approved loans in each case, the percentage of the total. This slide shows you the top 15 lenders, of course anonymous, how many approved loans were submitted by those lenders, and the dollar amounts and the average size. Now we have corresponding statistics for the EIDL program. In total, 26,900 loans. Here again are the state-by-state totals, the number of approved loans and dollars. This is the second part of that same list of the and these are the same statistics for the EIDL Advance Emergency Grant, the grant up to $10,000, which, if approved, would not have to be repaid, by the way, the way a conventional loan from the EIDL program would have to be repaid. And again, the remaining states on that list. So that brings us to the next phase of this program, the bill that was put together yesterday after some period of negotiations by the administration and Congress that were, I would say, a bit more contentious than the negotiations that led up to the first CARES Act and the PPP program. But yesterday they agreed to a $484 billion relief package. The deal was announced at approximately 1 p.m. yesterday afternoon. By 4 p.m. It had been entered into the Senate. The Senate passed it by voice vote late yesterday afternoon. And the House of Representatives has scheduled a vote for tomorrow. Now, the House has also called back all of the Congress people from around the country to come to Washington. They are anticipating that at least one member of Congress would object to having a voice vote, which would automatically require a recorded electronic vote in the chamber. So that's why they're all being called back. This new bill does not have any significant changes to the terms of the PPP or EIDL loans, but it does earmark various amounts of them for various purposes, and specifically for lenders to make sure that especially the smaller lenders and smaller businesses are going to be eligible for funding. A number of them are still pending and were unable to get funding in the first round. One interesting feature about this is that some funds are being earmarked for testing for coronavirus as well. As you probably know, that's one of the very contentious issues in this whole response to coronavirus that's being debated between the administration and Congress. It's unclear to what degree, however, any of the funding in this bill represents a move toward establishing a national strategy for the response to coronavirus. That is still being debated, I think, on political grounds. So what is in the bill, totaling $484 billion? $310 billion is being reappropriated for the PPP program, but $60 billion of that 310 is being set aside for smaller financial institutions. What that means, I found out just shortly ago, is that the $60 billion is being set aside for lenders that are under $50 billion in assets, and 30 of that 60 is being set aside for banks or financial institutions that are less than $10 billion in assets. An additional $60 billion is being set aside for the Eid L Program, 50 of which would be for the larger loan portion of that program, and $10 billion for the emergency advance grants. $75 billion is being made available for hospitals to recover expenses in treating coronavirus cases, providing more equipment, et cetera. The testing portion that I just mentioned is getting $25 billion, but 11 of that $25 billion is being allocated directly to states for increasing their testing capabilities. The remainder of the 25 will go to agencies such as the CDC, Center for Disease Control, the National Institute of Health, and up to $1 billion is going to be earmarked for being able to test uninsured individuals. Now, for those of you that are quick at addition, if you add up all of those figures, you'll come to a total of about $472 billion. I mentioned that the bill in total is $484 billion. I just found a little footnote a short while ago that indicates as well that that extra $12 billion is part of the total appropriation for PPP, but it covers the fees that are going to be paid to banks for processing these loans. Now, what's not included in this bill, which was under some very heavy debate, is funds for states and municipalities to fill budget gaps because of coronavirus response, and increasing the food stamp benefits for the 37 million people in America that are receiving those benefits. Those two issues are potentially to be included in the next phase of funding, which is already under discussion, and that's also going to be combined potentially with larger funding for infrastructure improvements around the country as well. So, Dean, I'm going to turn this back to you, and we can continue with the remainder of the program. I will be available for any questions.
Thank you, Lee.
Okay.
And I've got a couple questions that came in that I'll address in a few minutes around negative rates and SOFR rates. But first, we're going to continue with Doug Skinner with an update on the Fed actions, and then we'll get into some of those other questions around AFS and our support of some of these issues. Go ahead, Doug.
Okay, thanks, Dean. Over the last 2 weeks, the Fed has announced a series of programs and rule changes that are designed to increase the effectiveness of the Paycheck Protection Program. What's happened is, in addition to the operational challenges involved in standing up these programs that Lee was talking about, many banks are also quickly bumping up against capital and liquidity constraints that are limiting their ability to meet all the demand. So we've heard many reports of banks who have actually stopped taking applications altogether for P3 loans after hitting regulatory capital constraints or perhaps internal concentration limits. So we've seen the Fed step in to try and alleviate some of those constraints. So one of the things that they've done is create mechanism to buy the P3 loans from the banks after they've booked them. They've done this with something they're calling the Paycheck Protection Program Liquidity Facility. So this is a program the Fed created to provide financing to banks, so really so that they could just turn around and issue even more loans to small businesses. So basically how this program works is the Fed will extend credit to financial institutions that originate the Paycheck Protection Program loans and then take those loans as collateral at face value. The cost of the credit to the bank is 35 basis points, I believe. So 35 basis points of the principal amount of any loan that the banks choose to pledge. So at this current time, I believe this liquidity facility is only available to traditional banks, although the Fed said they are working to expand eligibility to other lenders. And then as Lee noted, I believe it was last Thursday, the Fed announced that this liquidity facility is actually fully operational. Then in parallel with that, the Fed modified the regulatory capital treatment of any Paycheck Protection Program loans that are pledged to this new liquidity facility. Because there won't be any credit risk or any market risk associated with any P3 loan that is pledged to the facility, the Fed was able to modify their capital rules to essentially make pledged P3 loans capital neutral, if you will. So in effect, for regulatory reporting purposes, banks then can apply what amounts to a Basel risk weighting of 0% for pledged P3 loans, meaning they don't count against regulatory capital ratios at all. So what does that really mean? Well, first of all, it frees up bank capital to make even more P3 loans. That's really important. But also a bank's tier 1 leverage ratio is one of the key capital barometers that comes into play really with almost everything a bank likes to do. So it's central to their stress testing. It's central to their ability to issue dividends and buy back stock. It even comes into play when they're considering mergers and acquisitions. It's factored into the FDIC deposit insurance premiums that they pay. So with this change, in one fell swoop, the Fed basically took all those concerns off the table in order that the banks could just focus on getting the money into the hands of as many small businesses as possible. Then last Friday, the Fed made yet another change. This time, it's centered around further expanding the universe of eligible borrowers. And what happens is oftentimes in these situations, you start to see the unintended consequences of legislation that was put together very quickly. And this is one of those examples. What the Fed is finding is that one of their long-standing regulations, Regulation O, is limiting the availability of credit to a very important group of borrowers. So Regulation O governs extensions of credit to insiders of a bank, such as board members and their related interests, their companies that they own. It also applies to certain bank executive officers, as well as principal shareholders of the bank and their related interests. So it's a regulation that's been around a long time, and its primary intent is to prevent favoritism in lending. The challenge you have now is insiders are often a very significant source of business for banks, particularly banks that are in small communities or even rural areas. And now the Fed's Regulation O is discouraging, if not preventing, some small businesses from accessing the P3 credit. So in normal times, insider loans have to be underwritten to a much higher standard. Those loans to insiders are often subject to quantitative limits, a certain percentage of capital as an example. They often require prior approval from the bank's entire board of directors, which is not something that can always be done quickly. Most boards only meet once a month. And there are certain other qualitative requirements that that affect the terms upon which an insider loan might be extended. And most importantly for banks, there are very significant penalties involved for violations of Regulation O. In fact, a lot of banks have an entirely separate underwriting track for insider loans. Some banks even shy away sometimes from making insider loans at all, considering the additional scrutiny they typically receive from regulators and auditors. But in the case of the Paycheck protection loans, these loans, as we're seeing and talking about, are critically important funding for so many small businesses, including those owned by bank insiders. So the Fed is making a temporary change to Reg O, not permanent, but temporary, to allow banks to make P3 loans to as broad a range of businesses as possible within their communities. Of course, including now individuals and businesses that would fit the regulatory definition of an insider. So the hope here is that many banks will now reevaluate their policies and underwriting practices that govern insider lending in order that they can provide financing to as many customers as they can, particularly ahead of the upsizing of the Paycheck Protection Program that Lee just mentioned and is about to happen. One comment on the Main Street Lending Program, there is no update. If you were with us last week, we went through that quite extensively. At that time, the Fed had said they were at least 2 to 3 weeks away from being operational. They have been collecting public comments in reaction to their draft term sheets and have not really commented yet on any changes that they're proposing. But certainly when and as they do, we'll be providing more information for you throughout the course of the next few weeks. Dean, I'll turn it back to you.
Thanks, Doug. Again, lines are open if you want to raise your hand, if you want to ask a question. I have a couple that I'll address here shortly. As far as the P3, and I know from Doug the way to say it is P3 loans, one thing we've noted talking to our clients is that the 10-day rule is in effect, which is to get funding completed within 10 days of the loan, I think, being approved from the SBA. So I know banks are dealing with that and working very hard to try to make sure they're in compliance for that. As we've said before, there have been varying degrees of automation that have been applied. AFS has an option through AFS Vision with our mass update tool. Our level 3 clients have various options, whether it's the traditional batch card input or some of the tools they've developed like Foxtrot. And we had mentioned there would be an option for us to develop some additional OFTI capabilities. We have not had anyone ask us to pursue that solution at this point, but it is still available. And of course, there's some manual booking shortcuts that I think banks are utilizing, including our short form screens and product definition screens. So if anyone has any questions or comments on those, let us know. Around loan deferments and forbearance, again, deferments are certainly unique, and with the uniqueness of commercial loans, trying to do a blanket policy or process to defer payments sometimes is challenging, and many banks are having to deal with these on a loan by loan basis. Again, using some of the tools that AFS gives you, whether it's the modification process or extension process or so forth, there's various things banks have been doing. If you're having additional challenges with that, please let us know. We certainly can talk to you about how you're doing things today, and if we have suggestions, recommendations for how you can be more efficient. The third bullet here is a billing type code mass update program that we developed very quickly for our level 3 clients. So if you needed to go in and do mass updates of loans to stop the billing process as a first step for deferrals. We do have a program that's available in level 3 to do that. So again, as an awareness, I think we've reached out to each client individually as best we can, but wanted to remind you here in this call that that is something that's available, and please contact AFS about that. As we've said, we are looking now at the forgiveness process, which is going to be a future stage, right? That we're going to have, we collectively, we AFS and our client banks, that we will have to deal with as far as how to process forgiveness on these loans. What is the operational process to do that? And certainly what is the GL and finance process to do that? And ultimately, what is the impact on reporting around the forgiveness process? So as I've said, look for updates coming up in future webinars where we will deal with that. Someone
Dean,
did ask. Yeah.
Dean, I'm sorry, it's Lee. Pardon the interruption, but I just wanted to add at this point about the deferment process. The SBA is obligated, according to the text of the CARES Act, to provide some public guidance on deferment within 30 days of enactment. So that should be coming up around the end of April when that's due.
Okay, thank you, Lee. And also along those lines for the SBA process, we've been monitoring the 1502 reporting requirements, and my understanding at this point, again, there is no change to the current process for 1502 reporting. Certainly there'll be a change with the SBA making payments in place of the borrower, but we're continuing to monitor that. And again, if anyone has heard otherwise or has updates on that topic around 1502 reporting, please let us know. Certainly that's an optional capability within AFS to produce the 1502 report or XML needed to fill out the report. So some of our banks utilize AFS for that. Some I think are doing on their own. Also, around this whole market impact of COVID-19, I had a question about negative rates and can AFS support negative rates? And the answer is yes. Up to this point, we've been tracking the ability to track negative index rates, and that is supported today in AFS Vision. And at AFS Level 3, there is a code update available to support negative index rates in Level 3. Several of our banks have already implemented that. And if not, let us know and we can talk to you if you're interested in getting that update to Level 3. Also, there was a question around SOFR for Main Street lending because SOFR is being recommended as the pricing base for Main Street lending, and we can support 3 of the 4 SOFR conventions today in AFS. The one that's still pending is the compounding in arrears. The ARC committee and the bank loan working group, I think, are still struggling to answer all the questions around compounding in arrears. It's been a long saga lasting almost 18 months now. And the latest we've seen is that final recommendations will not be out until July. There was a question about AFS's published schedule to deliver compounding and arrears capabilities. We continue to be on track with those dates to make those deliveries. However, if something changes from the ARC committee, our plan right now is to still be able to meet our published delivery dates. If it requires an additional update following that, then that's something we would explore. So far, we're not expecting any of that kind of significant change. But again, we will be scheduling a specific SOFR webinar coming up in the next few weeks, I think sometime in May. So if there's any more questions about that, again, let us know. You can ask now or send us a note. So also upcoming events, and we've been publishing from our business intelligence team here at AFS some market data, and so that has been distributed and is available on our website. So I wanted to call attention to that. And then also specifically some upcoming webinars. So we will have another COVID-19 update next week. And I think we may go to bi-weekly after that, depending on the volume of market changes that are occurring. We'll continue to monitor that. We have our AFS commercial and pricing webinar scheduled for next Thursday, the 30th. And then we will start a series of webinars for our AFS Leadership Summit, our conference that we needed to cancel the in-person conference, and we've converted that over to a virtual series. And the first in that virtual series will be on May 12th, and it will be a session focused on AFS vision and our cloud technology. Then there will be the COVID-19 bi-weekly updates starting May 13th, the RMA AFS risk analysis webinar will be on May 21st. And I mentioned the SOFR update to be determined which day in May we will be doing that. So they are some of the things that are upcoming. Any other questions for today? We'd like to express our appreciation for everyone attending today. And as always, everyone is in our thoughts and prayers, especially those who are dealing with the illness, those who have lost loved ones because of the illness. Certainly we're thinking about all of you. And we do look forward to speaking with you again next week. So Renee, I think we're going to wrap up. Thank you, everybody. Have a good rest of your day.
Great. Thank you.